Welcome to the deep dive. If you've turned on the financial news lately, you can feel it. There's this real anxiety in the air.
Oh, yeah.
Every headline seems to be shouting about the B word, right? Bubble. You hear about high valuations, meme stocks are back apparently, and just this worrisome exuberance.
That's the phrase going around. And look, it's fueled by some really impressive market gains. You can't deny that.
Exactly. And that narrative, it's everywhere. So that's why today we're trying to cut through that noise.
We are. We've got three specific studies, really data-heavy stuff from moneyflows.com. And they argue pretty strongly, actually, that these bubble fears might be, well, overblown.
Right. So our mission today is simple. Let's get past the feelings, the sentiment, and look at the hard numbers. What does history say? What about the Fed? What are the market mechanics telling us? Because maybe, just maybe, this run has more room to go.
Okay, so to really get into that, let's just set the stage quickly. Context is important here. This bull market run, it's been pretty incredible.
Incredible is one word for it. What are the numbers?
The S&P 500, it's up something like 35% just since early April 2025. That's huge.
Wow.
And that's on top of the run since the bottom back in October 2022. Total gain, but 87%.
87%.
Okay.
Okay. And that recovery phase, from late 22 into early 25, that holds a really key lesson, doesn't it? That was all fear and uncertainty back then.
Oh, completely. Constant recession talk. It was what the source material calls the definition of an uncomfortable trade.
Uncomfortable, yeah.
And the point they make is that the biggest wins, the really rewarding gains, they often come out of those really dark times. You have to be kind of proactive and fight that urge to just sell when everyone else is panicking.
Back at the fear.
Right. And now, after this massive rebound that surprised almost everyone, the new uncomfortable trade is fighting the urge to sell and lock in those gains.
Interesting. So holding on now feels risky too.
Exactly. But history suggests holding fast, even when you feel kind of exposed, that's often where the real long-term money is made.
Okay, that tees up the first argument perfectly then.
Yeah.
The idea that maybe selling now is just premature. Let's dig into that historical pattern. The strength you often see, kind of surprisingly, late in a bull market.
Yeah, we need to sort of tune out the current bubble chatter for a minute and just look at the historical record.
So what does it show?
Well, it's pretty counterintuitive, actually. That feeling of anxiety about valuations, that nervousness. History shows it's often precisely when the market puts in some of its most astonishing performance.
Really?
Yeah. Money Flows looked at major bull markets going way back to 1987. And what they found was that in the final 12 months, right before the bear market actually hits, the S&P 500 posted a huge median gain.
Okay, define huge. We're talking a few extra percent.
No. Think bigger. The median advance was 27.6%.
27.6% in the last year.
In the last 12 months before the top. Yeah. And just for context, that's nearly triple the S&P's typical average annual gain over 12 months.
Wow. Okay, that's a massive number.
It's a huge outlier. And it really suggests that, selling out just because things start feeling a bit frothy or you hear the first bubble warnings, that can be a really, really costly mistake financially.
Okay, but wait. If that huge gain, that 27.6%, is like the final surge before the music stops, doesn't that make the risk-reward calculation just terrifying? How do you manage that psychologically, knowing the gains are huge, but maybe the crash is closer?
That's the million-dollar question, isn't it? That's the real psychological hurdle. The sources suggest this happens because, well, the crowd finally tires of missing out.
FOMO, fear of missing out.
Exactly. Think about it. For maybe years, people have been cautious, holding cash, waiting for that big dip that just doesn't really come.
Yeah.
Eventually, they see the market keep going up. They feel like they're losing the race. And that fear of missing out just becomes overwhelming. They capitulate.
So it's not necessarily like amazing fundamentals driving that last 27% surge. It's more emotional, a performance chase.
That seems to be a big part of it. Skeptics finally throw in the towel. That late cycle momentum, fueled by money coming off the sidelines from those previously cautious investors, it just turbocharges returns.
Creates its own reality for a while.
Pretty much. And the source material suggests the smart money, the patient money, wins big by having the, let's say, intestinal fortitude to stick around for that final wave, knowing that the biggest party often happens right before closing time.
Fascinating. Okay, investor psychology is one piece. Let's switch gears now to the Fed. Because the second argument gives us another, maybe more concrete reason not to panic right now. We all know rate cuts are generally good for stocks, but
But the context matters. a lot.
Right. And the current context is stocks are near all-time highs. That's often cited as a reason why things are dangerous now.
And this is where the common narrative might be getting it wrong. The source material argues that, yeah, not all rate cuts are the same, and yes, the market's altitude matters, but maybe not how people think.
I'll explain.
There's a Carson Group study they point to. It looks specifically at what happens when the Fed starts cutting rates while the S&P's already trading, say, within 2% of an all-time high.
Okay. And that's exactly where we were when the Fed last eased back on September 17th, right?
Precisely. Now, common sense might say, okay, stocks are high, the Fed's cutting. That must mean trouble's brewing, time to sell.
Yeah, that feels intuitive. So does the data back that feeling up?
Actually, no, not at all. Since 1980, in those specific situations, Fed cuts, market near a high, the S&P, has actually averaged a pretty robust gain over the next 12 months.
How robust?
13.9% on average.
14.9. So the market doesn't see it as a panic signal. It sees it more like, what? Confidence.
That seems to be the interpretation. Like the Fed feels the economy is strong enough to handle slightly less tight policy without falling apart. The cut isn't seen as desperation. It's just adding a bit more fuel to an already decent fire. It signals the cycle isn't over yet.
Interesting. So the altitude isn't necessarily a negative sign when cuts begin.
Not according to this data. And there's more to that September 17th cut, which brings us to the third argument. It's about the timing.
Okay.
That September cut wasn't just any cut. It was the first one since the Fed had paused its easing campaign way back last November. Almost a year pause.
Right. There was that long pause. Why is that significant?
Well, the thinking is that pause itself signals something. It suggests the Fed felt the economy was strong enough to handle those higher rates for quite a while. So when they finally do resume cutting after a long break...
It feels less like panic, more like a careful adjustment.
Exactly, like they're being proactive, maybe fine-tuning, not reacting defensively to some sudden crisis.
And does the data show a difference here, too, between restarting cuts after a pause versus just continuous cutting?
Oh, a big difference. According to Ned Davis research going back to '76, when rate cuts resume after a pause of 6 months or longer, the S&P 500 has gained a median of 15% 1 year later.
15% median. How does that compare
Yes.
to just normal easing cycles?
It's significantly better. During ordinary easing cycles, where cuts might happen more frequently without those long breaks, the median 12-month gain was closer to 12%.
So 15% versus 12%. There's a clear premium for cuts that come after a long pause.
Yeah, the market seems to reward that measured approach implied by the pause.
And does that lift extend beyond just the S&P 500?
It does. The research suggests there's a flow-through effect. Areas that are really sensitive to confidence and liquidity, think small-cap stocks, NASDAQ names, they also tend to surge in the 12 months after the Fed restarts cuts following a pause, often with even bigger percentage gains.
Okay, this is critical stuff because, as you know, a lot of investors right now are wrestling with their portfolios. They're looking at these huge winners, the cyclicals, the tech stocks, and wondering, should I trim? Should I rotate into safer, maybe more beaten-down defensive stocks?
That's the big debate, and the source material ties the answer directly back to the Fed. Specifically, your decision on that rotation should really depend on how fast you think the Fed is going to cut rates going forward. The pace is key.
So it's not just if they cut, but how quickly.
Exactly. And the authors, the ones behind these studies, they lean towards the Fed continuing to ease, but doing it gradually.
And why do they think it'll be gradual?
Two main reasons they cite for economic resilience. First, this ongoing, massive AI infrastructure build-out, that's creating real capital spending, real demand.
Okay.
And second, the high-end consumer, surprisingly resilient. They account for, almost half of spending? And they seem less bothered by the inflation we've seen.
Plus, inflation itself isn't totally gone, right? That makes aggressive cuts harder.
Definitely.
Yeah.
The source points out core inflation has been kind of sticky, near 3% for almost 2 years now. Plus, you got worries about tariffs potentially pushing prices up. So, yeah, it makes it tough for the Fed to just slash rates aggressively.
So the base case is gradual easing. Let's call that scenario A. How does that translate into which sectors might do well?
Okay, so history gives us a guide here based on the pace of cuts. Scenario A, gradual easing. This usually happens when the Fed only delivers maybe 1 or 2 cuts after that pause.
Signaling the economy is pretty solid.
Right. Needs minimal help. In those periods, historically, investors favor cyclicals. They pour money into sectors like industrials, technology, and financials because those are most leveraged to continued growth. They tend to deliver the best median returns.
Okay, that's scenario A, the gradual path. What about scenario B, the faster cuts?
Scenario B is when the Fed has to get aggressive. Maybe 4 more cuts relatively quickly. That usually signals they're worried. They see significant economic weakness, maybe even a recession coming.
And in that case?
Confidence evaporates. Investors run for safety. They pile into defensive sectors, things like healthcare, consumer staples, the non-negotiables, the recession-proof stuff. Those deliver the best median returns when the Fed is cutting aggressively because the economy is weak.
Got it. So given the arguments for a fairly resilient economy, the AI boom, strong consumer source material, favors scenario A, the gradual path, and thus sticking with a cyclical tilt.
That's the lean, yes. But, and this is important, the recommendation isn't to just go all in on cyclicals and ignore the risks, especially this late in a potential cycle.
Okay.
They advocate for what's called a barbell sector strategy. It tries to balance things.
A barbell. Okay, sounds like balancing weights on either end.
Exactly.
Yeah.
But keep a healthy, significant weight in those cyclicals, your tech, your industrials, the things that should win if scenario A plays out.
Okay.
But on the other end of the barbell, you start actively buying high-quality, maybe depressed defensive stocks.
Yeah.
Specifically ones that pay good dividends.
So you keep your growth engine going with cyclicals, but you build a safety buffer with quality defensives, like a hedge.
Precisely. It's about mitigating risk. You ride the main trend, but you prepare for potential volatility or maybe a faster than expected rotation if the Fed suddenly does have to pivot to scenario B. It's a hedge built around quality names.
And are we seeing signs of this barbell strategy already playing out?
Well, the source suggests you can see institutions already doing this kind of rotation. They point to the recent pretty sharp rally in some big pharma stocks and other, beaten down healthcare blue chips. Money seems to be flowing back into those quality defensive names.
So for listeners thinking about what to do now, the idea is keep your core tech, maybe industrials, financials, but start looking at, say, utilities, those quality healthcare names, ones that offer stability and income.
That seems to be the playbook suggested. Aim for balanced outperformance. You stick with the likely winners in a gradual easing scenario, cyclicals, but you manage that late cycle anxiety by adding those high-quality defensives that institutions tend to favor when uncertainty ticks up.
Okay, let's pull this all together then. We've covered a lot of ground. The contrarian bull case, the argument against the bubble fears, it really rests on 3 data-driven points we dug into.
Right. First, that history shows massive gains. That 27.6% median often happen in the final year of a bull market. Selling early is costly.
Second, Fed cuts, starting when the market is already near all-time highs, haven't historically been a sell signal. Actually, the opposite, averaging almost 14% gains in the next year.
And third, when those rate cuts resume after a long pause, like they just did, there's a historical premium, a 15% median gain, which is better than during normal easing cycles.
So the big takeaway here seems to be, ignore the noise, follow the data.
That's the core message from these sources. The data suggests, yeah, we're likely in the later innings of this cycle, but there's still potentially significant opportunity left, especially if the Fed eases gradually.
And the strategy is that barbell approach.
Yeah.
Lean into the cyclical winners, but hedge with quality, maybe beaten down defensives.
Exactly. Go with the flows, but manage the risk.
We started off talking about that psychological challenge, right? Knowing that the biggest gains, that huge 27.6% median, come right before the end. It's rewarding but stressful.
It absolutely is. That final surge is where fortunes can be made, but it's also peak anxiety time. So maybe the final thought for you, the listener, is this. If you buy into this data, if you decide to stick around and try to ride that potentially powerful final wave, what signals will you actually use?
Not headlines, not feelings.
Right. What specific non-emotional data points or indicators will you watch to tell you, okay, the performance chase looks exhausted, maybe now it's really time to step aside? How do you plan to manage the emotional ride through that final, potentially very rewarding but also very nerve-wracking surge? That's the question to wrestle with for your own portfolio.